Japan's latest move in the U.S. bond market is making waves across the global economy, closely tied to rising tensions over electric vehicle tariffs. As Washington grapples with these developments, Japan's decision to offload U.S. Treasury bonds is raising concerns about the dollar's stability and the broader economic repercussions. The question is Japan using financial leverage to pressure the U.S. into easing trade restrictions, or is it taking a risky gamble that could have unintended consequences? Let's dive deeper into what's happening and what it could mean for the future. Japan has been one of the largest foreign holders of U.S. Treasury bonds, with investments exceeding $1.1 trillion, making it a crucial player in maintaining American financial stability. However, this long-standing financial relationship is showing signs of strain as Japan begins to reduce its holdings, a move widely seen as a response to mounting trade disputes over electric vehicle tariffs. On March 1, 2025, Japan's finance ministry issued a clear message, stating that diversifying investments was now in the nation's best interest. Markets reacted swiftly. The Dow Jones fell for the second consecutive day, as analysts interpreted the bond sell-off as a direct warning to Washington. For years, Japan's central bank has been careful in handling its foreign reserves, prioritizing stability over bold financial maneuvers. However, the growing trade barriers and accusations of unfair competition in the electric vehicle market have pushed Tokyo toward a more assertive stance. Selling U.S. bonds is not just about rebalancing reserves. It's a calculated move that could weaken the dollar, disrupt financial markets, and apply economic pressure on Washington to reconsider its protectionist policies. The U.S. quickly responded, with the Treasury Secretary emphasizing the importance of trust between allies and cautioning Japan against actions that could destabilize the global financial system. This back and forth highlights the fragile nature of economic and political ties between these two global powers. Yet, Japan isn't the only country rethinking its financial strategy. Saudi Arabia is shifting focus towards China, signaling a broader realignment in global economic alliances. The electric vehicle sector has become the epicenter of these tensions. Japanese automakers, including Toyota, Nissan, and Honda, have long been leaders in hybrid and EV technology. But in an effort to protect American automakers, the U.S. imposed tariffs on Japanese imports, a move Tokyo views as unjustified and harmful to free trade. Japan's finance minister hinted at further economic retaliation, making it clear that if Japan's economic interests are threatened by unilateral sanctions, other financial tools will be deployed. Japan appears willing to endure short-term economic pain to achieve long-term policy changes. Large-scale bond sales could push U.S. interest rates higher, increase borrowing costs, and unsettle global markets. A weakened dollar might lead to inflation and shake investor confidence worldwide. Tokyo's shift from financial caution to a more aggressive approach signals its growing frustration with Washington's trade policies. Other countries are watching closely. China, in particular, is assessing the situation as it considers its own response to U.S. protectionism. The US dollar's status as the world's reserve currency has long been a cornerstone of American economic influence. Japan's decision to sell off even a portion of its treasury holdings could significantly impact the U.S. economy by raising interest rates and increasing borrowing costs. If other nations, especially China, follow Japan's lead, the repercussions could be devastating for Washington's ability to finance its deficits and maintain economic dominance. Japan's central bank has already indicated its willingness to wield financial leverage, with the governor subtly implying that while Japan isn't looking to drain its reserves entirely, it won't hesitate to use its financial strength to protect national interests. Tokyo's strategy is bold but risky. Overplaying its hand could lead to a weaker yen and greater economic instability at home. Meanwhile, South Korea is weighing its own financial adjustments in response to mounting trade pressures, further complicating the situation. The electric vehicle industry lies at the heart of this conflict. The U.S. is eager to boost domestic EV production, leading to higher tariffs on Japanese imports. However, Japan's automakers hold a technological edge, having spent decades perfecting hybrid and electric powertrains. By imposing tariffs, Washington risks making EVs more expensive for American consumers, potentially slowing the adoption of green technologies and undermining environmental goals. In response, Japanese companies are already exploring ways to sidestep these tariffs. Shifting production to Southeast Asia and Mexico offers a potential workaround that would preserve access to the U.S. market while avoiding the added costs of import duties. At the same time, Japan's financial maneuvering sends a clear message: it won't stand idle while its automakers face unfair trade barriers. The implications extend far beyond Japan, and the U.S., China, and South Korea are observing closely. And if Japan succeeds in forcing Washington to reconsider its tariffs, other nations might use similar financial tactics to counter U.S. protectionism. This could erode the dollar's dominance in global markets, potentially shifting the balance of economic power. The geopolitical consequences could be even more profound. Japan is a vital U.S. ally in the Indo-Pacific, and continued trade disputes risk weakening broader strategic cooperation in the region. If Washington and Tokyo fail to find common ground, the rift could create opportunities for China to strengthen its regional influence. In the end, Japan's decision to reduce its U.S. Treasury holdings marks a significant turning point in global finance. If Tokyo proceeds with large-scale bond sales, the economic consequences could be severe, forcing Washington to decide between easing trade restrictions or facing rising borrowing costs and market instability. However, Japan's strategy isn't without peril. A weaker dollar could make Japanese exports pricier, potentially hurting its own economy. If the U.S. responds with even stricter trade measures, Japan might find itself in a worse position than when it started. So, what's your take? Will Japan's bold financial maneuvering push Washington to back down, or will the U.S. double down on its protectionist stance? Share your thoughts in the comments, and don't forget to like and subscribe to stay updated as this economic showdown unfolds.